And welcome back to Talking Money. This is Certified Financial Planner Professional Mike Miller, your host for today. So glad you're with us. If you got a question for me today, our phone number 877-235-9405. You can text me a question, or you can, of course, give us a call. That's what we're here for, to answer those questions. We're talking a little bit about the market and market updates that our investment strategy group that Ronald Blue Trust put together. And we do have copies of that if you want to send me an email to mike@talkingmoneyradio.com. We'll make sure we get that to you. And of course, you got a general question. If you listen via podcast, you obviously can't call in live to ask me a question, but you can always get that question to me via the website, the Talking Money Radio website. You can go to talkingmoneyradio.com and click on Ask Mike a Question. Or you can just send me an email to mike@talkingmoneyradio.com. And of course, that's the place that you can go to listen to previous broadcasts. So we'll post these broadcasts sometime next week, and then you'll be able to listen to that. Plus, you'll be able to go back to the archives to listen to other topics you may want to get brushed up on or learn some more about. We're not a sales call. This is not a sales program. So we're here to educate you. We want to make sure we get the information that you want. If you listen to one of the former programs or recordings we have, and you have a follow-up question on that, we'd love to have you. Love to answer questions. Love to teach. So done it on the radio and TV for years. So would love to have you join that conversation so we can help you get to straight. There are no dumb questions. There's only questions that don't get asked, and that's probably worst case, that you didn't ask the question and didn't have the right kind of answers and didn't get the right kind of objective advice. So 2 weeks ago, we started the conversation about retirement income and where are some good places to get that. And the very first thing I talked about, of course, you can pick it up at talkingmoneyradio.com. It's already been posted there. I talked about some of the highlights from that program. That one of the biggest accomplishments you can do preparing for retirement is to reduce or eliminate your debt. So if you got that gone, then when things like inflation happen, you won't be using higher valued money, more expensive money now to pay off debt that you really had when prices were lower. You bought that. Now you're paying it back with more expensive dollars, and of course you're paying it back with after-tax dollars. To be able to have the most flexibility in your retirement is to keep that debt to a minimum, very, very low, if not gone. Even your mortgage. If you've got a 3% mortgage, then you can argue that I could invest and make more than 3% over a particular period of time. I've got no problem with that, but you still need to remember the monthly payment still has to be made and all that kind of stuff. But you want to make sure you keep invested. If you've got cash sitting on the side, it's earning 1%, 0.5% or less, and those rates should start going up as the Fed fund rates increases. Your money market rates and those should go up along with it. And if yours is not, then you want to do some shopping around to see where you might get some better rates. If that money is only earning 1%, 0.5%, then even though you might have other money that's earning more than the 3% or whatever your mortgage is costing you, you still could be taking that money that's earning less than that for you and put it and pay it off that mortgage. But as long as you're still keeping a good reserve. So I think one of the best things to have, long term, obviously you can make more money stocks and even in bonds. But having, depending on where you are and what stage of your life you're on, having a good chunk of just cash, even if it's hardly making anything, helps avoid you from having to make rash decisions. You're ready for emergencies. You're not going to have to sell some of your investments while they're down. And I think that's important when it comes to retirement income, especially when you actually you retire, you don't have your earned income anymore, and you're trying to live off of Social Security, pension, and your investments. So some of the things we talked about before, we talked about Social Security, we talked about pension plans, when to take it, and so forth. We talked about CDs and treasuries, 10-year treasuries back up. Now we're at 3%. And I think, long term, if you look at the recent historical past, that's a pretty good rate. I talked about after tax, just regular brokerage accounts and your capital gains versus ordinary income. I covered all those things a few weeks ago. I touched a little bit on annuities. And I think one of the things that I really like to caution people on, especially in this season when you have the stocks very much struggling and bonds very much struggling, then it makes those annuity sales pitches sound even better. But you've got to remember that the insurance company is investing in those same things. So they're taking a hit. They may say, well, your contract says, though, you'll never go below zero. But you got to remember that with an annuity contract, what you really want to key on is not what the proposals are saying it could make, because that's all based on the stock market or bond market doing well. And that's what you're trying to protect against with the annuity. So you want to make sure that you know what the actual guarantee is, which in the indexed annuities is usually zero. You're guaranteed to just get your money back, and maybe not even that with some of the fees and things that are in that. So you want to be careful and understand what's going on. And then also be very careful. I've had this comment happen over the years, and I don't think there's a lot of difference in the structure of these indexed annuities as they've